Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to the Bert Salazar Retirement Show. My name is Bert Salazar, and I'm going to be your host today, as I am every single week. So I'm hoping that all of you are doing well and taking good care of yourselves and your families. This is episode 147, and the title for this episode is Your 401k is a Time Bomb in the Making. Once again, your 401k is a time bomb in the making. So why did I choose to do this today? And one of the main reasons is that, I get a lot of clients coming in, and also especially via video conferences and conference calls, and I get, many of you in my online community reaching out and sending me emails or calling me for certain questions and so forth. And one of the biggest concerns that all of you have, and you really never have that concern until you get to your retirement age, is, how much of your 401ks and retirement accounts are actually being taxed, and the impact that is having on your entire retirement distribution and your retirement life. So what I want to do today is I want to talk a little bit about the benefits of traditional 401ks, and then I want to spend a little bit of time on the 401k time bomb. And then the last part of it, the third part of it, will be how to diffuse the 401k time bomb in a way that you can maximize the return for yourself and your family, without having to deal with all the booby traps that all of these plans have coming to you. So for those of you that may not know this, 401ks actually became heavily as part of a product in retirement savings back in 1980. So the 1980s was the very beginning of a lot of the employers making 401ks part of their employee benefits, and obviously employees started making contributions to their 401ks. I would argue that over 95 to 96% of all the clients that come to see me for the first time, over 75 to 80% of all their retirement assets are in retirement accounts like 401ks, IRAs, 403bs, pensions, simples, SEPs, and all of those employer retirement accounts. So, and that's one of the major problems that I'm seeing, because most of these clients do not have any type of tax protection, and we're going to spend a little bit of time on this today. So, but then again, one of the things that I tell you all, and I tell all of my clients, is you don't have to throw away the baby with the bathwater, meaning that, you should be able to take some of the best features and benefits of each product and then make sure that you pair it up in a way that is going to maximize the return for you and your family. So what are some of the benefits of traditional 401ks? Well, number one is forced savings through payroll deductions. So once you opt in to do payroll deductions, you're going to get those deductions on a monthly basis, on a weekly basis. If you get paid bi-weekly or bi-monthly, they're going to take that right off the top. And that money is going to go into your 401k depending on, what the asset allocation was that you chose at that time. Now, the other benefit is that the contributions are being made on a pre-tax basis. So that means that if you're making $100,000 and you put $10,000 into your pre-tax 401k plan, then you're only going to pay taxes on $90,000 and not on the $100,000 that you earn. So the pre-tax contributions is going to help you reduce your taxes for the current year. For many of you, there's also an employer match. Now, there are some employers out there, and I've seen many of those plans that they don't do a match. They just offer the 401k option to their employees. But there are a lot of employers that do give you a match, and they can match you in many different ways. They can give you a dollar for dollar match up to a certain percentage, and then 50 cents on the dollar up to another percentage. So it really depends on your employer and how it is that they designed that plan document in your 401k. Now, traditional 401ks also provide tax-deferred growth, so you don't have to pay taxes on an annual basis on the growth of your money, and that allows for the money to perhaps even and grow at a faster pace and so forth. And then there's also delayed access to retirement funds. So that means that unless you're going to be meeting exigent circumstances, and we'll touch upon some of those in the next few minutes, the money's going to continue to grow on a tax-deferred basis, and you shouldn't be touching that money until you get to your retirement age. So hopefully you're going to have a lot of money there at the time that you retire. Now, those are the traditional benefits of 401ks. And the challenge that I have with many of my clients is that's where the education stops. They're only looking at one side of the ledger, and they're not looking at the other side of the ledger and all the other booby traps that can have a negative impact on the outcome of those retirement plan assets. So now let's get a little bit into the 401k time bomb. And why do I call it a time bomb? Because it's ticking every single day of every single week, of every single month, of every single year for as long as you have that 401k in place. Now, what are some of the items that you need to pay attention to? Well, limited liquidity due to age 59 and a half and age 72 rules. So if you pull money out prior to age 59 and a half, unless you meet one of those exigent circumstances, not only are you going to have to pay taxes on that money, but you're also going to have to pay a 10% premature distribution. And then the new rules, the 72 rules, that's when you hit your required minimum distribution. So whether you need the money or not at age 72, you're going to be obligated to start taking money out of those accounts in order to pay the taxes to the IRS. Now, if you fail to take those required minimum distributions, as I have stated many times, you're going to have to pay taxes on the amount of money that you should have taken out that you didn't. But you're also going to have to pay a 50% excise tax penalty on top of that. So if you fail to take $10,000 out of that account, $5,000 of those dollars are going to go straight to that 50% excise tax penalty. And if you're in the 25% marginal or effective tax rate, then another $2,500 is going to go out the door to the IRS. So out of a $10,000 account, 75% went to the IRS, and you only kept 25%. So you have to be very careful of understanding the RMD rules when you get to the age of 72. Now, between now and your age 59 and a half, there are a number of different ways that you may be able to pull money out of your retirement accounts, especially your 401k. One is that if your employer allows it in their plan document, you can borrow from your 401k, so you can take out a loan. Now, the maximum amount of loan that you can take out is $50,000. And then obviously if you take out, let's say you take out $25,000 as a loan, not only do you have to pay that money back, you have to pay it within a maximum of 5 years. So you have to pay the loan back within 5 years. And then the other issue that happens with the loan is when you pay the money back, you're actually paying the money back with after-tax dollars, and that creates another issue and perhaps a double taxation issue that I'll talk a little bit more in the next few minutes. So you can have access to your 401k assets via loans. You can, if you're a first-time home buyer, then you can take up to $10,000 in order to purchase a home. Obviously, if you have a death or a disability, you can take money out. And then one little way to take money out, which is not very well known to most Americans, is what is known as a 72T distribution. in which the IRS says, look, if you're 55 years of age and you want to take money out of your 401k, and you don't want to have to pay that 10% penalty, and you don't want to do a loan, and you're not a first-time home buyer, and you're not dying, and you don't have any disabilities, then you could take money out under a 72T distribution, which means that you're taking equal and periodic distributions on an annual basis. Now, the rules of engagement for a 72T is that you have to take the money out for a minimum of 5 years or age 59 and a half, whichever is longest. So let's say that you are age 50 and you want to take money out on an annual basis out of your 401k. Then you have to take that money out until at least 59 and a half, because it's either 5 years or 59 and a half, whichever is longest. Now, if you happen to be age 58, when you want to start taking those distributions, and you have to go to age 63, because 5 years is longer than age 59 and a half. So you have to understand those rules. But if you abide by those rules, then you're just going to have to pay the tax on the distribution, but you're not going to be forced to pay that premature 10% distribution penalty. Now, pre-tax contributions, they equal delayed taxation, not tax savings. So when I gave you the exercise that if you make $100,000 and you put $10,000 into your 401k, yeah, you did not pay taxes on that contribution in the year that you make the contribution, but you're not saving any taxes. All you're doing is you're postponing the tax, and then when you postpone the tax, you're also postponing the tax liability. So that's a major problem that you're going to have in the future when it comes to distribution of your retirement assets. So remember that pre-tax contributions are pretty much a delayed taxation, not tax savings whatsoever. And then obviously you have that tax deferred growth, which also equals tax deferred liability. Because you're deferring the taxes on the money that is inside the 401k, but you're also deferring the tax liability. And you're not going to know what that tax liability is until you start taking money out at some point in time in the future. Now, another major problem with traditional 401ks is that there is no credit for investment losses, and that's a big issue. Now, another problem is that retirement income is taxed as ordinary income rates, which are normally the higher rates that Americans are going to be taxed on. So it's not going to be a capital gains taxation. It's going to be ordinary income tax rates. Another issue is that retirement income can negatively impact the taxation of Social Security benefits. For those of you that have a lot of money in 401ks, anytime you take money out of those 401ks, not only are you going to have to pay taxes at that point in time at whatever tax rate you're going to find yourself in, but also that distribution is going to have a negative impact on the taxation of your Social Security benefits. And I bet you didn't know that when you started making contributions to your 401ks. Now, retirement income can negatively impact your Medicare premium as well. So if you're taking too much money, or that's the only place where you can take money off to maintain your standard of living in retirement, if you take too much, your Medicare premiums can actually go up, and that's a bad thing. So there are a lot of issues that can create a time bomb, and that have actually created a time bomb for those of you that have been making large amounts of contributions to your 401ks, for many, many years. Internal 401k fees can actually reduce account values as much as 25%. And I see it because I do all those calculations for my clients. Most 401k companies are going to be charging anywhere between 1% and 1.5%. Some may even charge up to 2% of fees. And those fees are going to be charged on your retirement accounts, whether you make money, you lose money, or you break even. So every single year, that company that is going to be managing your 401k assets is going to get paid no matter what. So you have to be very, very careful with the fees, because a 1% fee can actually mean a 25% reduction in account value over a 20 to 30 year period. Now, another major problem, and this is a big fallacy, because most Americans are living in a mystical world, because you look at your statement and you see $1 million account statement on your 401k, and you think that entire $1 million belongs to you, and that's not the case. See, you never know what your net account value actually is in your retirement accounts, because the IRS hasn't told you this, hasn't told you yet. Remember, the IRS is the general partner in the partnership of your 401k. See, when you put money into a 401k, you actually go into a partnership with the IRS, where they're going to allow you to play with their money, have you play with their money for as long as you want, up to age 72. But then they're going to take over, and they're going to dictate what percentage of that those retirement accounts and those retirement assets actually they're going to take away from you. And you're not going to have any choice on that, because they are the decision makers when it comes to your 401k. So another big issue is that 401k account values can actually impact or negatively impact your access to governmental programs that may be available to you and your family in the future. So, there's a major time bomb. The problem is that most Americans, most of you, I would argue, have never really thought through these issues, or perhaps you were not aware of these issues that you got to pay attention to, because at the end of the day, it's about how much money you keep, not how much money you have in your retirement accounts. So I guess the next issue, and let me just drink a little bit of water, and the final issue that I want to discuss with all of you today is, well, if I've given you the benefits of a traditional 401k, and I've given you the 401k time bombs that are going to be there whether you want to or not, then the final point would be, well, how do you diffuse the 401k time bomb? And there are a number of ways, a number of things that you can do in order to start diffusing the negative impact of that 401k when it comes to your retirement assets. Number one, limit your contributions to employer match, but never higher than 7% of income. Most of you that come to see me for the first time have been maxing out on your 401k for a number of years, usually the last 10 years of your life or before you get to retirement. That's when you really start to max out your contributions. Don't do that. You should only limit your contributions, or you should limit your contributions to the employer match, but never more than 7%. Now the question is, well, Bert, what do I do with the rest of the money? Because I need to put more money away for my retirement. Well, if that's the case, contribute your additional retirement income to either Roth 401ks, Roth IRAs, or 7702 plans, which are cash value life insurance plans. And there's going to be more information next week because I'll talk about the Roth 401ks or Roth IRAs and 7702 plans to get you a little bit more information and education along those lines. What else can you do? Point number 3, limit your traditional 401k account values to no more than your standard deductions offset levels. And this is one of the major calculations that I do with my clients when I do tax planning for them. See, if you do it the right way, you can put money into a traditional retirement account on a pre-tax basis. The money can grow tax deferred, and then you can pull the money out tax-free if you use standard deduction offsets. Now, I'm not going to go into details on this because some of you and your incomes are going to be totally different, and your standard deductions obviously are the same for everyone. But many of you have the ability to itemize your deductions, and now it gives you a little bit more leverage. So I'm not going to get into that. But make sure that you keep your total account values to be within those limits, because then once you hit age 72 and you have no choice but to start taking distributions out of your retirement accounts, if you have stayed within the adequate limits, then you're not going to have a negative impact on your retirement distribution planning. Now, and I'll get into this a little bit more next week, but if you can't contribute to a Roth IRA due to your income levels, then consider a backdoor Roth. And I'm not going to go into details because I'm going to spend a little bit more time on this next week. But there's a way that you may be able to make contributions to a Roth at a point in time in your life where your income is preventing you to actually making a contribution to a Roth IRA. But I'm going to share with you how it is so you can do it, and I'll do that next week. Another point is consider Roth conversions on a portion of your current retirement savings. So that's a big issue. And all of you that have 401k, traditional 401k account values, you do have the ability to make Roth conversions on an annual basis. You may also consider a 7702 plan as soon as possible. The benefits are unmatched. And obviously more to come on this issue when we discuss it next week as well. 7702 plan is a cash value life insurance plan that if you use it correctly, it can do things for you and your family that no other account can do in the United States. Another point is that, if you can't take a deduction for 401k losses, and this is a big issue, you know that if your account values, your retirement account values, or 401k values drop by 20 to 30% on any given year, you can take a loss for those losses. Now, if you had an investment outside of your 401k, like a traditional investment in a mutual fund, or if you had a stock or real estate or whatever it may be, and you had a major loss, you can take capital losses and then you can offset capital gains with capital losses. Well, in retirement accounts, you can't do that. But here's my question to all of you. If you can't take a deductions for 401k losses, then why expose your 401k to stock market volatility and risk altogether? That makes no sense. If you can't take a loss, why expose your retirement assets to that? So there are many ways that you can do it in such a way that your account values are never going to lose at least the principal and or the interest earned on your investments. And, we can talk about that at some other point. Another big issue is that since most Americans will run out of money in retirement, especially before they run out of life, you need to start to consider guaranteed paychecks for life with some of those traditional retirement accounts that you have in place, like your 401ks. But what if you can do guaranteed paychecks for the rest of your life, so neither you nor your immediate family will run out of money in retirement? But what if you're able to do so with a Roth conversion strategy that will allow that income to come out now on a tax-free basis as well for the rest of your life? So now you're starting to see how 401ks, especially traditional 401ks, have so many different moving parts that most of you have never paid attention to. And you haven't paid attention to because you have been on the accumulation stage for many, many years. But you fail to realize that the rules of engagement totally change when you go from accumulation to distribution. And this is what I'm trying to do with all of you by educating you on these issues on an ongoing basis. Now, and this is, a final point for all of you is that, most Americans have no clue about managing their retirement accounts. And this is something that I see quite often. They have 401ks, they may have 403bs, they have IRAs, and they have them all over the place. But when it comes to distributions, they have no idea what account assets to invade first, what account assets to invade second, what account assets should they try to avoid invading until they get into the slow-go years and the no-go years of their lives. They don't understand how to manage losses in those retirement accounts. They don't understand how to manage the distributions to stay within the standard deduction offsets. So there's a lot of things that many of you have never paid attention to, and that I'm hoping that this podcast can bring to the forefront. So, for those of you that want to reach out to me and you want to pick my brain about some of the issues that we have discussed today, please feel free to give me a call. You can call me at area code 786-766-1042. Again, 786-766-1042. You can also send me an email at Bert, B-E-R-T, at bertsalazar.com, BERTSALAZAR.com. And always remember that my goal for you and for your family is to kind of help you change the way that you see things, because when you change the way that you see things, the things that you see change. So once again, thanks very much for giving me a few minutes of your time today, and I'll talk to you soon. Take care. Bye-bye.